Aloha and good morning from beautiful Kauai. I'm actually sheltering in place, not sitting with the Hanalei Mountain background. This is Ron Margolis. I'm with eXp Realty. And my guest today is Anthony Valentino from Guild Mortgage. And let's see, we're going to be talking about, let me bring up the title slide here. Our subject today is forbearance, funding, and the future. And we're also here to answer your questions. If you are listening live, then thank you so much for attending. And if you're watching on the replay, you certainly can email any additional questions to myself, Ron at landinkauai.com, or Anthony, want to give them your email address?
Absolutely. Thanks, Ron. They can email me at avalentino@guildmortgage.net.
And I think do you see the chat box on your side of things?
I do.
If you do, you can also type your email address in there for viewers to watch.
Absolutely.
So, Anthony, take a few minutes and give our viewers just a little bit of background on yourself.
Absolutely. Thanks for having me, Ron. I appreciate it. My name is Anthony Valentino, and I'm with Guild Mortgage. I'm a senior loan officer, and I run teams based out of Las Vegas, California, and all of the Hawaiian Islands. And so I've been in the market of finance for almost 2 decades. My background is in finance and specifically with renewable energy. I kind of took a sidestep on renewable energy and focused more on the economic aspect. And here I am doing more of a banking finance. But that's my background. I've been in the mortgage industry for about 7 years with Guild Mortgage. And we do everything from home mortgages, jumbos, refis, you name it, anything to do with mortgage, we're there.
Cool.
So, yep.
We've got a lot to go through today. So, of course, there's been a lot of questions about the housing market, and we're 2 months in, for some people, more than 2 months of sheltering in place and watching so many changes in the American economy. And fortunately for the housing market has remained relatively stable, although it has slowed down a lot. And in the mortgage market and the world of banks and money, things have been very volatile for many months. And of course, COVID-19 has added to that volatility. So let's go to our first talking point. And what are the lending forbearance options that, let me rewind. Earlier on, maybe you know the genesis. Why don't you talk to the genesis of when the forbearance legislation came about, and go from there.
Absolutely. So obviously, we're seeing some unprecedented times right now where it's not just a small fraction of the U.S. being affected, it's the entire population. And so they knew they had to do something, them being the powers that be, Congress, legislation. So they enacted the CARES Act to make sure that there's going to be no short-term or long-term effects economically at the end user, unlike in 2008 where the big banks got bought out and the end user really didn't have anything to show other than a short sale and a foreclosure. Now they've kind of learned their lesson to say, okay, let's see how we can help the whole ball game here, not just one side. So they enacted the CARES Act for forbearance, where if you've been affected by the COVID, then they could do a forbearance on your mortgage. So that way you're not financially impacted, both on your mortgage payment as well as on your credit side. And so that was a big bullet point in the CARES Act to make sure that not only are people going to have advantage of doing a forbearance and pushing off their payments, but also to make sure that it's not going to have lasting effects, both short-term and long-term, on their credit. Because, you know, if they help you short-term but don't help you long-term, that's really not helping anyone out. And there's been a lot of misconception on, okay, what's a forbearance? What does it entail? Is it different than a deferment? And so basically, if you look at what Fannie Mae and Freddie Mac, the two major purchasers for the mortgage-backed securities, had to say, basically, there's a couple different options in forbearance of what you guys can do as homeowners. So if you own a home, then there are some actions that you can do. More than likely, it's either going to be owned by Freddie Mac or Fannie Mae or FHA or FHA loans. And so if you do have a mortgage, then you've probably already talked to your mortgage servicer, and they give you the options of a forbearance. That forbearance has subsets of what you're able to do. You can either do a forbearance, and right now they're doing basically a 3-month, a 6-month, and a 9-month period. They're doing the first step with 3 months, which started in February. So you got February, March, and April. And then if it needs to carry on, they'll do an additional 3 months for a total of 9 total months forbearance. So you have to talk to your servicing or your mortgage company to see where you're at with it. Make sure you keep contact at all times. But when you're in forbearance, that's going to give you options. Are you going to do a full repayment once that time period is done? Are you going to have a short-term payment plan, you know, within 3 months, 6 months, 9 months, add whatever you pushed away onto your additional mortgage? So, you know, do you want to take that action and have a higher payment for 3 to 6 months? There's a loan modification. If you are susceptible to where you can't refinance, they can do a loan modification, actually change the terms. And the biggest key factor is the new bullet point, which is the COVID-19 payment deferral. So this was enacted to say, listen, if you're going to do a forbearance, we do not want you to have your client, as in the buyer, to have to make up all the payments after the deferment ends. So if you start a deferment and in 90 days, 3 months later, technically you have to pay those 3 payments that you deferred on that 4th payment. Who has 4 payments to pay after you're coming from this financial catastrophe? So they enacted that COVID-19 payment deferral that states, as long as you can abide by say July 1st, 2020, then you will be able to put the payments at the end of the loan term. Now you have to talk to your mortgage servicers because they'll begin offering this starting July 1st. But if you can't pay it within a 3-month, 6-month, 9-month term, you can add an extra $1,200, $1,500 a month to your existing payment to catch up on the ones that you threw back. They are offering that deferral that falls into COVID-19 to where you can throw it at the end of the term and keep your same payments. And that's going to save a lot of people who are strapped for cash. And it's going to put people in a lot better pace. So that way they're not having to focus on keeping a roof over their head. They can focus on things like food and you know, medicine and stuff like that.
How will any of those options, if I'm, I think I read recently that 11% of the mortgage holders have taken advantage of this option. How do I know what will happen to my credit? Will there be any kind of repercussions of me making one of these choices?
That's a great question. So there's a lot of gray area in this because it's kind of like they're making it up as it goes because it's unexpected. So to add to your point, it was unprecedented that, like you said, over 11% of mortgage holders requested a forbearance. That is huge when you have millions of loans. And what that does is it puts a damper on the system, the secondary market. It creates liquidity and insolvency issues because now all of these banks are basically not having any money put in the coffers, but they still have to pay the secondary market on the MBS. So now they're losing money. And so thankfully, the federal government stepped in and gave discretion and counsel on how they could mitigate that. So to answer your question, as far as the credit side, there is language in the CARES Act that specifically states that the creditors cannot make a derogatory remark on your credit. In other words, it can't say past due. It can't say late. It can't say not meeting expectations. They can't put any late blemishes. There is some focus on the comment and the note section of your credit. So although they can't put a late payment on that trade line, they are putting comments like natural disaster affected, COVID-19 affected, economically affected, and they're putting this in the comment section to TransUnion, Experian, and Equifax. And what we're finding on the algorithm is some people are stating that they're seeing their credit drop once they add these comments. Now, we don't have any factual basis on this until we actually can do a case study. I have some clients that I'm doing case studies myself to see, okay, was it because their credit cards were utilized different, their end ratios were utilized, was there something else, or was it strictly because when they did go in this forbearance and the creditors put a comment that it was, COVID affected, did that comment specifically make a negative remark in the algorithm of the credit? So as of right now, there is language stating that you can't be credit affected. And if you see your scores drop, I definitely would call TransUnion, Experian, and Equifax and ask them to either remove those comments or change those comments to see if you can see that score change on your end.
Another question, how does someone qualify, or does someone need to qualify for forbearance?
Well, basically, everyone who has a mortgage qualifies. Under the CARES Act, they basically said that you don't need to have like the normal documentation for a loan modification or an economic downturn to where, hey, I lost a job. Typically, you have to put in documents, taxes, pay stubs, documentation to prove it. In this case, it is a blanket across the board, and it was advised to all servicing entities that if someone states that they're COVID affected, they don't have to give you one piece of documentation, and you are able to go into a forbearance. Now, this goes to conforming loans. This is loans that are conforming and are usually sold to the secondary market. You have loans that are called non-conforming, which are portfolio loans. They are not on the same rule set as conforming loans. Those are your bank statement loans. Those are your niche loans with credit unions that hold it with themselves. And I have seen that those portfolio loans actually are cutting through the red tape because they have none. And I have found that my buyers who have those portfolio loans are already doing deferrals, meaning the bank said, listen, we know that this is hardcore. We're going to throw 3 or 6 months in the back of the loan. Don't worry about it. So anyone can basically do a forbearance. And if you have questions, call your mortgage servicer, the people who you pay your mortgage to, and say, I've been affected by COVID. What can I do? What are my options? And they will help you. Absolutely.
That's great. Also, you had mentioned, and I just put it up on the screen, if you want to know if your loan is a Fannie Mae or Freddie Mac loan so that their guidelines apply to your loan, you can go to knowyouroptions.com/loan lookup, and you simply just need to enter your information, enter the property address that the loan is issued on, and your social, and they'll tell you if it's serviced by them. And additionally, if you want to see if your loan is serviced by Freddie Mac, you can go to their page, which is at Freddie Mac's website /loan lookup, and that will that will tell you who services the loan. Any other guidance, Anthony? If I'm a homeowner and I either haven't chosen yet to get forbearance or I'm in forbearance, any kind of parting thoughts on that one subject?
Yeah, that's a great question, Ron. So, there are repercussions for forbearance, okay? And so one of the big things I'm seeing is everyone knows that mortgage rates are at an all-time low. I mean, they've never been this low in 5 decades. Since the conception of them monitoring the rates in 1971 is when it's never been this low. And so if anyone has a mortgage and you're over a 3.5%, you need to be refinancing. You need to be refinancing and talking to people like myself to drop that rate, because rates are super low. Now, when you do a forbearance, that does put a hurdle with refinancing. Up until last week, if you did a forbearance, you could not refinance for 12 months or a year. And so a lot of people were up in a tizzy because there was also some issues with people calling about forbearance, but not necessarily doing forbearance. And because there was no documentation needed, a lot of these calls were just, hey, they called about forbearance, I'm putting him in forbearance. And then they would contact me, a lender, and say, Anthony, I want to refinance and drop my rate in those twos like you're going to be able to get me. And then I look at their credit report and it says affected by the COVID. And now we have to wait 12 months, and they're devastated. Because so many people were affected that way, they just enacted last week that they've dropped it to 3 months. And they've also said that if you asked for a forbearance, but you kept up with your payments and it was just kind of like I'm not sure if I need to, and then you weren't affected and you were able to pay your mortgage payment, then you are able to refinance. And then we can just confirm that even though you asked for the forbearance and it's notated on your credit, you've kept up with your payments. But if you have, in fact, skipped a payment, then you have to have 3 payments after the forbearance is ended in order to be eligible to do refinancing or to do cash outs or anything like that. So I would stress to everyone that if you want to set yourself up for long term, because when you do a refinance, you can already skip a couple months of payments. So it's kind of setting you up for no options if you go for the forbearance, if you have an opportunity to refinance and lower that rate.
Okay, well, that's a lot of information on forbearance, and as you mentioned, over 11% of the mortgages, so a high percentage of American homeowners have chosen that option, and hopefully will help get the message out in terms of what are some of the pros and cons. I'm going to move on to point number 4 here. What changes, if any, have taken place in the lending market? And you talked about interest rates, but can you give us a sense of where interest rates are? Gee, if I want to make an offer on a property today and I need to go to a lender like yourself to get a pre-qualification letter, what are the rates, and what kind of more broad-based changes are we seeing in the lending market?
Absolutely. So right now we're in times that we've never seen. And, obviously what's going on is there's a multiple set of actions that have happened over the past 6 to 12 weeks that have set a chain reaction that has changed the market. Prior to COVID, pre-COVID, rates were in the mid 3s, upper 3s, but you had plenty of different banks that were offering a plethora of secondary market or niche products, bank statement loans, condo-tel loans, jumbo loans, asset pledge loans that aren't conforming, loans that if you didn't fit in the box, and there was a lot of brokers out there. As soon as the COVID crisis hit and the market crashed, that started a liquidity issue. And then the forbearance wave came to where everyone was wanting to refinance and do forbearance, which created insolvency in the market. And that's when the federal government had to step in, and they began buying mortgage-backed securities as much as they could buy, basically $200 billion worth, in order to stabilize the market, because overnight the rates went from the 3s to the 4s, and there was like $20,000 price tags to it. And so this COVID created uncertainty, and that uncertainty is not good in a market, because market is based off of futures. And if the future looks uncertain, it looks rocky. So because the Fed stepped in and they just inserted all this money into the market, it's stabilized. So right now we are looking really good. We don't have as much loans like we did, where you can do a 3% down jumbo. Now you have to put a 5% down jumbo minimum. But bank statement loans, they're really not around right now, but they'll come back. But the rates are looking good right now. The past week, we've been seeing them do amazing. The feds and them injecting all of this money into the mortgage-backed securities, it's working. And now we have some calm in the markets. The rates are in the upper 2s and lower 3s right now. I even have middle 2s if we go to a 15-year, which is unheard of if you told someone that you're going to get a mortgage with the 2s. And that can save people $600 to $700 a month, depending on how big of the size of the loan. So right now, to purchase a house with historic low rates, with not a lot of people in the pool shopping, and having a realtor like yourself be able to secure that offer, it's a really good time to buy right now.
Any other things that have changed? What about loans for home equity?
Loans for home equity. That's kind of a tongue twister. That's definitely changed. You are seeing all the big banks put a stop to cash out refinances. And it makes sense, because if you think about it, the market has insolvency and liquidity issues. And so the last thing they want to do is give money out and add cash to it that's real liquid, not just in the form of a mortgage-backed security. And so that's why you're seeing big banks stop cash out refinances. There are cash out refi and HELOCs available. They're still available with the smaller banks. My bank has not been affected. I still can do cash out refinances. Gill Mortgage has not been affected at all. We have maintained course, and we still offer all our programs, whether it be FHA, conventional, jumbo, cash out refi. Our partners that we work with for HELOCs, they're still going. It might trickle down. It just depends on what we're going to see within the next 3 to 6 months. As long as we can see this economy go back open and we can see a positive like we're starting to see, then I think the storm is behind us. We just don't know because it's all new.
Okay, by the way, if you're viewing this live, you can certainly place a question in the chat, whether you're on YouTube or Facebook, and the presentation will be archived. Additionally, if you're watching it on archive, if you have lending questions, you can always reach Anthony Valentino at avalentino@guildmortgage.net. And let me bring up, let's see, there you go. Oh, that looks like me. If I can get a refinance, maybe you talked about this a little earlier. How do I determine if that makes sense for me?
Yeah, so, it's all about the math, right, Ron? We want to make our dollars into cents, and we want to make sure that what we're doing is economic. We don't just want to be doing things because. We don't want to refinance because. We don't want to refinance cash out. We want to make sure that everything we're doing has an economic value to it. And so that's where someone like myself comes in to say, okay, what are we doing? Why are we doing it? And what's the outcome? And what are the savings? And so there's basically 2 aspects of savings when you refinance. You are lowering the rate, which is going to lower your monthly payment. And it's also going to lower the amortized loan throughout the next 20, 30 years, 15 years, whatever your amortized loan is for. So not only are you going to see potential savings on the interest of the loan, but you're also going to be seeing the savings on the payment reduction. There's also a lot of times where you can take off mortgage insurance if you put minimum down under 20% and you still have mortgage insurance. Right now with the house prices really stable and high, a lot of people who bought 2-3 years ago have at least 20% equity so they can take off that mortgage insurance. So I would say if you're not going to use someone like myself and you have your other lender, make sure you ask the questions are, what am I saving? And what am I saving per month? And what am I saving on the life of the loan? So you want to look at that amortized value to make sure that it makes sense, because if you're spending, say, $3,000 for a refinance, how long is it going to take you to make up that money? Is it going to take you 1 year, 2 year, 3 year, 5 years? Because if it's more than 3 years, and you may sell or you may do something with it, that's something you want to make sure you're looking at the details to make sure that you're making a good decision when refinancing. There's another thing that I always show people that they don't understand is a lot of people have car payments or credit card payments. Say I have, Mary and John, they want to refinance. They have 2 car payments that are $600 total and say another $500 in credit cards. So that's $1,100 a month. If they were to take the balance of those, put it into a cash out refi, they may up their payment by $300, but now they wipe away $1,100 a month and those higher rates on those simple interest loans. And so looking at that, that's a big option to where you can look at your overall portfolio, utilize and leverage a refinance to consolidate your debts. And so you're leveraging your equity in your house to, rather than just sitting there, it's being used to put you in a better financial position.
What about, I know, part of if we have any new home buyers or first time home buyers watching this, part of the process of getting a loan is you fill out a loan application, of course, and you can usually do that online at Anthony's website or any lender's website, and they can usually tell you fairly quickly how the next step, once the lender has all of your paperwork, is that the file is going to go to a loan underwriter, right?
Yeah, absolutely. Yeah.
And then at that point, how is underwriting being handled in terms of, my credit is good, I was making a good living, now I'm on, I'm furlonged, or I don't know if I'm going to have a job. How are those people just totally out of luck at this time, or how is underwriting responding to this situation?
That's a great question. So the good news is it's not a dead end road. It's not, oh my gosh, I have a year or 2 years to climb out of this hole. The good news is that there are extenuating circumstances and there are life situations, and underwriters are real. They're human and they too have been affected. And so it's all about making sense of the situation. I have people, who have been furloughed or are on unemployment or basically lost their job. And the good news is if they go back to work, they're not starting from scratch. As long as they don't have a 6-month job gap and they don't wait 6 months to start over, they're not going to see any big hurdles to overcome. I have people who were off the job for a month and now they're back on the job. And all I need to do is to do a quick updated verification of employment, get the latest pay stub, confirm that they're still making the money they were making, and we're going on down the road. So just know that it'll pass and it's not going to derail them. We just need to make sure that once they're back at work, everything's the same. And if it's not, readjust the numbers so that way we're setting ourselves up for success.
That makes sense. Let's see. One final question, unless we have questions from any of our viewers. As the economy recovers, and we're not really sure of the timing of that, of course, what do you see? I know the mortgage rates change every day, right? Sometimes more than once in a day. What's the general sense of the industry and from where you see it going forward? What are we likely to see through the end of the year? The head of the Fed has been expressing lots of concerns about the economic recovery. So many people out of work. What do you see going forward?
I'm an optimist by nature. I'm also a realist by practitioner. So I have to make sure I balance those and make sure that my optimism doesn't oversee my realism. The reality is we are in unprecedented times. This is going to go down in history. We're going to be talking to our children's children about what we went through over the past 6 months. It's never happened before. We have an invisible ghost that is wreaking havoc on people emotionally, financially. And it's not just privy to one person, it's everyone, some more than not. So we are in an ugly situation, but the good news is I think that we are working our way out. I am seeing positive aspects come out of this, and I am seeing us learn from the information we have And I do think we're going to come out of this, and we're going to come out of this stronger. This is not like the 2008 recession or the 1980 recession. This is different. This is the market is there, but the consumer has left the market. It's not the market wasn't there and the consumer was wanting to be in the market. So with that issue, it's only temporarily, in my opinion. Having a degree in finance and looking at the numbers on an intrinsic level, the math doesn't lie. The curves are showing that although we did see a big correction, it's going to be temporary, and hopefully it's going to be quick that we're going to see this recovery. Once people get back to work, and once we find out the little small specifics that we need to do to keep us safe, the 6 feet, the masks, the antibody testing, the precautions, the safety measures. Once we get this and we get our feet under us, then I think we're going to see this economy start going back up to where it left off. And this little blip will just let us know that even though it's bitter, we do know how sweet the sweet can be. And I do think we will come out at the end of the year. I am giving a prediction that by the end of the year, we're going to be in a lot better shape. I do think rates are going to continue to stay low, if not go a tad lower. And I do think that we're going to see a recovery. I do think we're going to see an impact on the workforce, and some people are going to be permanently affected. But I'm hopeful that with the economy emerging, there'll be other jobs that will be able to replace that to pick up of where this good economy left off just 6 to 12 weeks ago.
Okay, well, hopefully your optimistic crystal ball will happen. It's difficult to think about of the 40 million people that are currently unemployed. With all the changes, many of those jobs are likely not coming back, and there's got to be some residual effect from that. Last night on PBS, there's a show called Insights, and they had 12 different stakeholders from around the state, people that work in tourism, a gentleman that represents the hotel workers labor union, a community advocate from Maui, one from the north coast of the Big Island, Chipper Wickman from the National Tropical Botanical Gardens here. And one of the big issues, of course, for the economy in Hawaii is tourism. And one of our property segments that you provide mortgages for are second homes and vacation rentals. Mm-hmm. And one of the concerns coming up from the community side of the discussion last night was about how people have taken this time to take a step back. They've had chances to be with their family, kind of rethink things, have a different experience of being on our roads, on our beaches. And so there's some group of people, or many people, that are saying, hey, when we bring tourism back, how can we do it wisely? Hawaii gets 10 million visitors a year, and one of the people who owns a hotel or a hotel group in Rafter was speculating that we will be lucky to get to a million travelers this year. And in that industry, they were looking at changes, more automation in the hotel industry, eliminating bellmen and, doormen, and doing more things through technology. So, while the housing market is strong and the government continues to prop up, it's curious as to what's going to happen long term. And another comment that sort of threw me for a loop last night, as this discussion was going on between these 12 people, and they invited Governor Ige and the head of the Hawaii Tourism Authority. Unfortunately, both of them declined to come, and they're really the people that can, make the decisions. One person was saying, well, we're not going to have enough tourists to keep our hotels surviving, but since it's going to take so long to bring it back, why don't we just get rid of all the vacation rentals in the whole state? Mm-hmm. And I started to think, well, that would really be something. Of course, there would be some benefits, but on the downside, think of all the revenue that the counties and the state would be losing from all that vacation rental tax that they collect from those people. So it'll be interesting to see down the road. I wanted to take a minute just to segue to talk a little bit about our market here. And I had provided in our last broadcast with Luke Evslin some numbers from March and April. And to give you an update in terms of sales here on Kauai, today is the last business day of the month. Of course, it's only the 29th of May, but escrow offices and the Bureau of Conveyance is closed on Saturday and Sunday. So compared to last year, you can see that the number of transactions that have happened in May, in other words, sales that have closed, is down close to 70%, 68.42% from May of last year. And the number of properties listed is down, but only by a little bit. So trades continue to happen. And while we haven't seen a lot of effect on the price, certainly the amount of people trading is down. That's not necessarily true in many markets on the mainland, but these numbers are probably fairly consistent for Maui, Hawaii, and Kauai, the neighbor islands, because, hey, a lot of the people that buy on these neighbor islands don't live here, and right now they can't even come here without being quarantined for 14 days. In fact, just today, they announced this morning that Governor Ige has extended our quarantine, 14-day quarantine rule till the end of July. So, you know, any thought of tourism coming back in July, I guess that's probably not going to happen. Here are the numbers for condos, by the way. Also for May, you can see that the number of condos sold on Kauai in May was down 57.45% from May of last year. And the number of new listings is down. And of course, the dollar volume down 70%, and that's significant. So it's going to be interesting to see what happens with our vacation rental properties. Obviously, they're all still shut down. If I own a vacation rental on Kauai, I may have the option to long-term rent it, but I've got to rent it out for at least 6 months. I can't rent it for month to month, just temporarily, because that's not considered a long-term rental. So a lot of homeowners are considering, you know, maybe I should rent it out for 6 months because I'm not sure how much tourism we're going to have, you know, when it gets to that point in time. This is a slide I showed from our last broadcast, but you can see once again the increase of visitors coming. And, you know, at the moment that everything stopped, basically in March, we were at a rate of having 10 million visitors to the state, and we're not going to be, you know, I don't know if we'll ever be at 10 million. I don't know if the state, you know, the mindset of each of the counties and their mayors and the governor is really to let tourism to come back to that degree. So we'll just have to see. I want to thank you for spending all the time of your busy day to educate our viewers about some of the issues that homeowners are facing or may face in the future. And you alluded to it before, but if I'm fortunate enough to have my job and I'm thinking about getting into the market, although here on Kauai, there's not a lot to choose from, you know, in homes under 500,000. But as you said, it's a pretty good time to buy, isn't it?
It is. It is a really good time to buy. You know, the best time to go into a pool is when no one's in it. And right now, not a lot of people are in it. So you're not going to have to negotiate as much. You're going to get a lot better of the terms in your favor as a buyer. And, you know, getting a super low rate, that's not going to just help you for short term, but long term. So we do know one thing: this is not going to be forever. It's not. This is not the end of the world. It feels like it, but we do know that we're going to wake up one day and we are going to be out of this. And when we're out of this, we're, you know, we want to set ourselves up for the best situation possible. So, you know, it's hard to think long term, especially when right now is not good. But just know that it will pass.
Amen to that. We're all in this together, as I've heard many times.
Yes.
Well, on behalf of the Margolis team, which is myself and Bailey Hutton and Catalano Mobley and Anthony Valentino of Guild Mortgage, I want to thank you for watching this presentation. You can see Anthony's email on the screen there if you've got a question. And if you got any questions for myself or my team, feel free to email me, or you can call me at 808-346-7095. And you can call Anthony at
702-287-6937, or you can simply go to the website myislandhomeloan.com and read all about me and services, and any questions you can plug in, and myself and Ron with the Margolis team can help you out.
Sounds great. A hui ho, be well, and we'll see you next time.